Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement with Chris McIntire. McIntire Retirement Services, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning for our financial, investment, retirement futures. He is president and founder of McIntire Retirement Services. Chris McIntire with us once again. Chris, welcome back in.
Hey, nice to be with you there, Peter. And for those of you that are on the video here, I'm in a different room of the house here as we evolve through the COVID-19 things. And up here in the loft room, that's going to be my permanent office. I had to relocate Robin outside and move some of her craft goodies and all of that. Man, it was a long fight, man. It only took about 7 months, but I was victorious. And I only say that because she can hear me.
At one point, you were relegated to the garage area, Chris, and now you're giving us a tour of the house, kind of one show at a time, changing locations around on us. But I know that you have been facilitating meetings with your clients, reviews with investors and savers who have questions and concerns, all the same, just as before COVID, except through the ease, the convenience, the safety of technology, and you staying relatively quarantined. Although at this point in time, you are holding in-person reviews in office if need be as well, correct?
Sure, on a limited basis. As Peter knows, I'm somewhat of a germaphobe in the pre-COVID world anyway. So yeah, and it's wearing masks and whatnot. So that's the nice thing about having a couple of different offices is we don't have to worry about integrating with staff and whatnot. And sometimes it's come in, do some quick signatures. And, sometimes we need what we call wet signatures, original signatures that can't be scanned and whatnot. But I'd say probably 99% of our business so far this year, Peter, has been done on the virtual side of things. And, I'm getting used to it. I don't mind it, because I worked in 3 different offices anyway. So, have it being remote and that type of thing from staff is just something that I've always done anyway. So it doesn't matter too much to me. Heidi's probably happy to have me out and about anyhow.
Port Clinton, Fremont, and Norwalk, correct?
Perrysburg,
the Perrysburg office. I forget the main one.
Yeah,
Chris,
exactly.
Serving conveniently for savers and investors across Northwestern Ohio, though, and of course with the radio signal reaching many of them each week in areas even beyond.
Absolutely. And, it's nice that, Peter has been able to help me with some video here and get a podcast going so people can go to the website and watch different radio shows and whatnot. And, he's certainly more techie than I am. And we've got Megan at the office who's as techie as Peter is, but she's off on maternity leave still. So my goodness, man, when you lose your techie person there at the office and don't want to interrupt her, she's married to our nephew. So we're trying to give her plenty of time to adjust. But when something technologically goes amiss there, all right, we got to start.
It's like you got an arm tied behind your back trying to fight the battle.
Oh man, it can. And Zoom can be one of those for sure. Sometimes I connect with people and it goes right through. Sometimes they gotta, they can see me, can't hear me, that type of thing. So, hey, we understand, folks. We're right there with you.
The troubles of modern times. Well, one thing that is certain is that if you need to get in touch with Chris and the team from McIntire Retirement Services, you can do it with a good old-fashioned phone call. Just pick up the phone, give a call, 800-868-1194. That's 800-868-1194. You can get online. You can check out all of the podcasts, the video or the audio, whichever way you choose to consume that. McIntyreRetirementServices.com. And if you want to connect and follow them in any of the social media platforms at McIntire Retirement Services. So again, if you have any questions, if you'd like to get answers to your specific financial issues or concerns, 800-868-1194. That's 800-868-1194. And Chris, as Americans, we like to only think about taxes really one time a year, or that's the only time we really do think about it. We don't like to think about them even then. But really, it should be a much more proactive process. We should be thinking about them more often. And here, as we are in October already, hard to believe, but extensions for those that filed extensions, that deadline's right around the corner. And as we get into the fourth quarter, it's really a good time to sort of review the progress that we've made this year, see how things might be different, and try to identify some opportunities.
Absolutely, Peter. And, when we have discussions with clients, I can think to a couple here in just the past week that, we talk about Roth IRA conversions, and I've emailed accountants here a few times lately to see, how much more money can a certain client pull out of an IRA account, pay tax on, and move it into a Roth, call that a conversion, convert that to a Roth IRA so that it will become tax-free eventually. So that's a good thing to be looking at here into the fourth quarter. And, why that makes sense to do it in the fourth quarter is, you're going to turn a new calendar year on January 1st. So for most folks, when it comes into, say, October into early December, they've, earned most of their income. So they have a better chance of, doing Roth conversions later in the year because there aren't any big surprises. They're going to say, oh my goodness, something just came up and I've got to pull out a big chunk out of my IRA account that I wasn't intending to. And as you know, you cannot undo a Roth conversion anymore as part of the Secure Act as well. So to kind of summarize that a little bit, maybe Peter will help me out here, is, late in 2019, Congress passed a couple of different rules changes, law changes with regard to IRAs. So when the IRAs are passed on through the beneficiary document to a non-spouse IRA, so a kid, a grandchild, niece, nephews, brother, sister, somebody you're not married to, they have to empty that IRA account within 10 years. That's a big change from being able to stretch it over your remaining life expectancy. So the Roth conversion side of things is probably going to take a bigger precedence once we get COVID here behind us. And then they also bumped out the required minimum distributions to 72, which is a good thing. And then for, many folks here in 2020, there isn't any required minimum distribution. So if you didn't need it, you didn't have to take it this year. So, and all these things are tax related.
Yeah. And Chris, when Congress changes the rules on IRAs and retirement accounts like they did with the passing of the Secure Act, to me, that just really emphasizes who's ultimately in control of those accounts. And yes, they're our individual retirement accounts, but we've got a business partner in those accounts, Uncle Sam. And the reason why looking at taxes around this time of year might be advantageous is when there is opportunity, we should be taking advantage of it. And within any given year, there's kind of a use it or lose it opportunity. And that's why you're having these conversations about proactive tax planning to take advantage of the rules as they are today, the known situations that we have, the known guidelines and parameters, to take some of the variables out of our financial future.
Certainly. And, right now we've got the hot button issue of the election up and coming here. So political forces are at play here, and we're going to try and stay politically neutral here. Every once in a while we get a voicemail or something where somebody thinks we're taking a political side, and that's not our intentions by any stretch. So, there's been talk about taxes changing here, depending upon the outcome of the election. Now, that's not going to happen on November the 4th or November the 5th. That could be into 2021, 2022, depending on the outcome of the elections. Taxes, like on capital gains, could certainly go down if certain candidates win. Taxes could go up if, we get changes in power in the legislative bodies of, the Senate and the House of Representatives. So it's not like, the president can say, all right, I'm going to raise taxes on everybody, or I'm going to cut taxes on everybody. It's got to go through, the three steps of government, essentially, the House, the Senate, and the president. So,
but again, not our house. We don't set the rules. It's that house up in Washington that ultimately does it.
That's correct. And, we could probably sit here and make a fair argument that with all the money that they've spent to, get through COVID, to get through the 2008 financial crisis, and then deficit spending, which is something that's just become commonplace here, At some point you have to pay for that. And the only way to pay for that is if the government reduces spending or they raise revenues or a combination thereof, and not something that they've been, reducing spending is not something that they've typically been well rehearsed at.
Ever. Ever, it seems like. Again, I'm gonna take this, Chris, from kind of the global, national, political level down to our individual level. But I want to again reiterate and emphasize that, ladies and gentlemen, listening, viewing on the podcast, on the radio program today, if you've got questions or concerns, if these are areas that you specifically want to discuss in your planning and set a plan in motion for yourself and have some direction from an experienced, qualified advisor, pick up the phone and give Chris McIntire and McIntire Retirement Services a call, 800-868-1194. That's 800-868-1194. Given the backdrop and the setting and the situation that we just described, Chris, do you believe that mainstream Americans, workers and savers planning for their financial future, even those already retired, need to rethink our perspective on taxes? And I phrase that question because I believe that deferring taxes has been something that people enjoyed taking advantage of in retirement accounts, but it assumes that taxes will be lower into the future. De facto, by nature, if we don't pay a bill today and we defer it till later, we're hoping to pay less at some point in time. Do we need to rethink that?
Well, in 1986, Peter, the median tax rate on somebody making $68,000, okay, in 1986, which was a pretty good income, was like 38%.
Plus some additional taxation in there potentially.
Yep. So in 1986, if you made more than $68,000, the federal income tax rate on that was 38%. Today in 2020, the 37% level is the highest tax bracket. And for married filing jointly, that's on $622,000.
So it's come down significantly since 1986.
That's right. Yeah, because right now at $80,000 of income, you max out the 12% tax bracket.
So almost a third reduction.
Absolutely. And if you put inflation in there, and from 1986, $68,000 is a pretty good chunk of change in today's terms, probably 120, but that's still 38% on 120,000, where today that'd be 22%. And again, guys, for those of you that don't realize this, guys and gals, we start with zero taxation until we meet, after our standard deductions that we get. So for a married couple, that's $24,400. You don't pay any income on the first $24,400, zero. Okay? Then you hit the 10% tax bracket, and that stops for married filing jointly at $19,750. Okay. Now remember, you get $24,400 on top of that, so that's basically $40,000. Okay, and then you go to the 12% tax bracket all the way up to $80,000 in change, plus the $24,000 standard deduction. So, man, it's going to be hard to make an argument that income taxes are going to get any lower than where they're at now. They may do some things with capital gains taxes, which deals with non-IRA assets for the most part, or people that buy and sell real estate, that type of thing.
So again, Chris, looking at where taxes have been in our nation's history as high as 90%, there has been a 90% tax rate on high income earners, down to where they are today, a significant decrease. So maybe perhaps workers and savers who saved under the assumption that taxes would be lower in retirement when they started saving back in the 80s and through the 90s made a correct assumption with their planning and with how they set themselves up for retirement. But looking at the tax environment today, could this be a key opportunity to do that proactive planning and then save on taxes moving forward? Because it's not what we make, it's what we keep. And if we've got an opportunity to buy our tax bill off when it's on sale, I would like to do so.
Yeah, correct, Peter. And, in the more financial success someone's had, the more they need to do some planning. And, because not everybody's going to spend every last dime that they've created.
Wealthier people make larger, more expensive tax mistakes, in other words.
Oh, absolutely. And then they end up passing on more of those headaches to their children. So take, for example, somebody listening to the show today, has $1.5 million, $2 million between a husband and a wife. Pretty common these days, I mean, with everybody that's, been investing in the stock market and, has had time to accumulate. Now they don't have a pension, so they typically are going to have a bigger 401k. That's the cause and effect. And let's say they pass away and they're going to move $1 million from their IRA account down to their kids. Well, the government last year made a change that said, okay, that $1 million, instead of being stretched out over 25, 35 years, depending on the age of the beneficiary, has to be emptied within 10 years. Okay? And what are the income tax rates going to be in 10 years? Because we don't set those rules, somebody else does. So, that's why we want people to be more proactive in their tax planning. And I would say that, some of our income kind of gets us into, we'll call it some of the loopholes. We step in a pothole, for example. And
double whammies. There
you
are additional implications and repercussions of taxable income in retirement that a lot of people don't fully realize or understand. Probably should be explained a little better. So Chris, what are some of those potholes that we could step into?
Yeah. So let's say, for example, in your retirement, husband and wife, or even if it's just somebody who's divorced or widowed, that type of thing. Once you want to buy a condominium down in Florida, get out of the Ohio winters, that type of thing, the gray skies, all that stuff we deal with. And, you say, look, I don't want a mortgage. I know it's going to cost me a tax hit. I'm going to pull $150,000 or whatever out of my IRA and buy the condo. I own it free and clear. I bit the bullet on the taxes that year. Okay. Then all of a sudden Medicare looks at your income taxes and say, you know what, based on your income 2 years ago, your Medicare premiums are not $140 and change like they are right now. They might be $340 a month because of your taxable income. So that's kind of the double whammy. You've got to dodge some of those potholes or, work the loopholes that are in there. Social Security also can be taxable as well. And, they've never adjusted the parameters on where Social Security becomes taxable for inflation. So there's still the 1983 numbers, the 1993 numbers, and, more and more people that file for Social Security are paying tax on, either 50 or up to 85% of what your Social Security is. Not at 85% tax rate, guys.
Right.
Just
right.
85% of what you receive can be taxed by the federal government. The state of Ohio does not tax it. Certain states also do tax it, but thankfully, Ohio does not tax Social Security benefits.
But a lot of people believe that Social Security is a tax when they pay it during their working career and don't understand that income actually can be taxable to us when we receive it in retirement. And if we count and rely on gross numbers and don't remember to include the taxation and that effect on our income, then we're going to have to create additional income from other sources and potentially pull down on our personal assets quicker than we anticipated. And you indicated the two thresholds. In 1983, they instituted a 50% threshold. 50% of most Americans receiving Social Security, 50% of their Social Security income itself was included in taxable income. And in 1993, they included another threshold that bumped many Americans' income threshold of taxation on Social Security up to 85% of their Social Security benefit became taxable. So again, not thinking proactively about our taxes, Chris, has sort of a triple whammy compounding effect. The income withdrawals themselves are going to be taxable. It could cause our Social Security income to also be taxable. And then our Medicare premiums are also means tested based on income and can be significantly increased if we have certain thresholds of taxable income. So taxation in retirement, a totally different picture than let's defer and delay and kick that can down the road.
Absolutely. At some point, the rubber meets the road and you're going to have to do that pay as you go system. And the problem with that is you don't get to set any of the rules. And, Peter said that, a lot of people view what you put into Social Security as a tax, Okay, because they take it out of your pay and they put it into something where you have no control over it. And Peter and I are both self-employed, so I would certainly agree with Peter on
We
that.
understand that a little bit more painfully than others may.
Yeah, if you look on your Social Security statement, I'm 55 years old now at the time of recording this show, and on my Social Security statement, my employers have only put in $8,000 into my Social Security fund. I've put everything else in there because I've been at this for self-employed since I was 26 years old, so almost 30 years of contributing money into an account I have zero control over and can't take it out until I'm 62. And if I do, they're going to penalize me 30% of what I would get if I would wait until 67. So would I rather have control of that money? Absolutely.
Sure. But Chris, regardless, self-employed or working for a company and employer, 1099 income, W-2, we're all paying into this Social Security system, and we all hope to one day be able to retire and create a lifestyle for ourselves. Many of us are doing that in tax-deferred accounts. So here's where the question comes in. Does guidance on this matter? I mean, do we need to rethink this? And are people receiving the right kind of tax planning advice and direction that they should?
Most likely they aren't. And, people need to change the paradigm, change their way of thinking, because like Peter said, and most people understand is, we go into this now thinking our income is going to be lower in retirement. And for many people, it is going to be lower in retirement. You're not making $100,000 in retirement unless you're pulling $100,000 out of your 401k and combining that with your pension income. I just did a phone call with some folks that, live here in Northwest Ohio. And they said, look, if we can live off of $50,000 a year in retirement, we'll be comfortable. And, they make over 100,000 right now, but their goal retirement income only needs to be 50,000. So, and like, look, you don't have a tax problem. So you don't really need to worry about the Roth IRA side of things. You're not going to have enough income where we need to reinvent the wheel here or introduce in a new strategy. Now, if I got somebody that says, hey, I don't need much income, but I've got a big 401k, there's where we want to start slicing some pieces off. Because remember, at age 72, on $1 million 401k, you've got to pull out almost $40,000 out of that. And every year you get older, you got to pull more and more money out of it. So why not start taking that money out sooner and put it into a Roth IRA where it's going to be income tax free? Then you can pass it on to beneficiaries if that's the goal, whatever your goals are. And then you don't have to worry about, somebody changing the tax rates much later on in retirement that, could be significantly higher than where they're currently at right now. As, at some point you have to pay down some of these deficits. This hole that we've dug is pretty deep. And, at some point you need to fill that back in.
Well, again, if you need help in your personal planning, if you would like to take some of the variables of taxation and what the future may hold out of the equation of trying to figure out what your retirement looks like, pick up the phone and give Chris McIntire a call. How to be strategic, how to identify opportunities to control that tax bill, keep more of your hard-earned money. 800-868-1194. That's 800-868-1194. 800-868-1194. Bottom line, Chris, when we retire, there is a big change in the way we need to handle and think about handling our taxes and our tax situation. And when we are looking at our investment plan or our accumulation plan, we think about it one way, but the paradigm shifts when we look at retirement income planning. And you have talked about putting together that written retirement income plan. Part of that process for your clients there at McIntire Retirement Services in that written retirement income plan is including these variables of taxation and how to better control that bill.
It absolutely is. And Peter, to tell you, I'm kind of a tax geek. I like, trying to make sure that we're maximizing distributions for clients that make tax wise decisions for them and their beneficiaries. And it's nice, like the other folks I was just talking about, is that, look, you don't need to get crazy. You don't have, enough dollars where taxation is going to be a huge problem for you. Just keep putting money into the 401k right now and you'll be fine. for other folks, look, we need to think about doing some things different. You don't have any tax-free money. All you have is taxable dollars for your retirement. And, if you're going to be a big spender or something, why not get some money where you can offset your taxes and choose when to pay them?
Well, we don't want any surprises. And Chris, when we walk into a store, we look around and try to find things that are on sale. Although ultimately, just because something's on sale, typically we don't have to buy it. One way or another, with taxes, we have to pay that bill. The government, Uncle Sam, is not going to forget about the money that we ultimately end up owing them. So why not buy our taxes? Why not pay that bill when it is on sale? And Chris, I think you would agree that right now is really the time to look at that.
Yeah, it certainly is, with the tax rates where we're at right now. And I would assume that if, the election goes where one party is in particular power, we could see some changes in the tax environment, and that could be good or bad. I'm not here saying who's going to win or anything like that.
You're just saying either party, there could be impacts.
It could be taxable impacts.
Sure.
And, I think that makes sense to most people here, and we're not picking sides by any stretch.
Well, Chris, in the red zone, which we've talked about before being kind of the 5 to 10 years leading up to retirement, and then the 5 to 10 years after retirement, really there are particular windows of opportunity. And that's really the time when most people have the greatest amount of control over their tax bill.
Yeah, they certainly do. And, especially for those of you that are just getting ready to retire, if you're going to spend a lot of money, you're typically going to do that early in retirement, not necessarily later in retirement. And remember, the government mandates that you take money out of your retirement at 72, your IRA type accounts at 72, and every year thereafter. You cannot take that money and convert it into a Roth IRA. So your tax planning ability is typically before age 72. And for some of you, really before age 65, where you have the ultimate piece where you don't have to worry about Medicare premium taxes as much.
Well, again, if you need help, if you need assistance, Chris McIntire does offer a complimentary review. Now, this review is comprehensive. You can look at many different aspects and angles of your financial and retirement planning life, and specific questions, issues, concerns will be addressed. The fees that you're paying, the taxes that you may be liable for, the risks that you're taking, how to maximize available sources of lifetime income, such as Social Security, making a true impact on how much of your personal nest egg needs to generate income for you, how to answer the question, am I ready to retire, or how much do I need to retire, and how to translate and transition that lump sum that you've saved and worked so hard for into the income to support that retirement lifestyle. If you've got questions of any of those areas and want to address them more specifically in the tax planning, proactive, look-forward approach, trying to control and minimize that ultimate lifetime tax liability and bill, pick up the phone and give a call, 800-868-1194. That's 800-868-1194, 800-868-1194, 800-868-1194, or go online, McIntyreRetirementServices.com, McIntyreRetirementServices.com. One final thought, Chris. A lot of people really panicked or did not like what they saw in the market and their accounts at the beginning of the year as COVID was making its full initial impact. The markets lost 30%. There at McIntyre Retirement Services, you talk about being proactive. You actually look for events like that as potential opportunity to help your clients improve their financial outlook, specifically from a planning perspective.
Yes, absolutely, Peter. And, this has certainly been a challenging year for many investors, many advisors, and, dealing in a world of pandemics for the first time ever. But there's been some great opportunities out there. And, we always will, discuss using well-diversified portfolios built around your overall risk tolerance, in general, to help maintain your financial success.
Well, your success is important and ultimately is contingent on avoiding as many mistakes as possible. If your financial life is climbing a mountain, retirement really is kind of the peak. The red zone is the pinnacle. And many people make mistakes on the ascent. Many people, unfortunately, make mistakes on the descent. And throughout retirement, we have to plan for protection and we have to plan to preserve that lifestyle, and minimizing that tax bill is one effective way to do that. Oftentimes as effective, if not more effective, than shooting for higher returns, but with far less risk. And if you'd like to look at how to keep more of your money intact, pick up the phone, give Chris McIntire and McIntire Retirement Services a call, 800-868-1194. That's 800-868-1194, or visit online, McIntyreRetirementServices.com. Chris, we always appreciate the time. Thank you for your guidance and being the resource for Northwestern Ohio savers and investors.
That's my pleasure, Peter. And everybody enjoy your weekend out there, and please be safe. Take care. We'll talk to you soon.
Visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.